the exact level or proportion that would make your asset allocation at a very precise level. But unfortunately, in Asia, the number of offerings still limited, especially in Thailand for now. So if there are more ETF that is available, you can make some match to get a more precise exposure. And for now, Thailand actually has a number of sector ETFs to choose from. So I think this portfolio completion can actually work for maybe if you have a Thai exposure fund portfolio, you can use these Thai sector ETFs to complete your portfolio. And here I actually have an example where a portfolio completion example here. Say, for example, if my portfolio currently has two funds, equity funds in there. Again, I'm using the Fund Awards winning funds here, the Pupun and Aberdeen, each have 50% weight, say. And using our Morningstar Direct institutional platform to take an X-ray into what these two funds actually has invested in. These two funds, if you look at the equity sector breakdown, you can see that they are very heavily invested into the cyclical equity sector. So this might not be something that I really want to. So so what do we do here? Say, for example, we actually wanted 40% in cyclical and only 30% in, and I would like a more heavy weight in sensitive and defensive to 30%. So say from 15% to 30% and almost 70% down to 40%. How do we do that? I think this scenario is very common. It may be for a case if you have only got two funds in your portfolio that you are comfortable with. You might not be able to find another exact fund managers that you could find which is doing good enough job to have your exact asset allocation 40-30-30. So what do you do with that? So now I would like to plug my holes in this situation. I would like to plug those holes. So what I would do would be to sell 20% of the in each of the two funds and buy 20% into the exact sector ETFs that I would like to gain the exposure in, the equity exposure in. So again, taking the same picture again, taking the same X-ray. This helped to after adding the two sector ETFs into my portfolio, 20% each. You can see that the equity sector breakdown has already increased to about 70 from before 70% into cyclical down to about 40%, and from 16% in sensitive raising to 30%. So this is a very precise portfolio completion strategy that you can perform on by using ETF as well as your existing fund portfolio. So you can sort of use different proportion of ETFs to mix and match to pinpoint into your asset allocation target. Right, so other than these strategies that I talked about, ETFs can also be used as a risk management tool, and ETFs are usually very liquid and transparent, and therefore they can be used in many ways, including like risk management. For example, if there's a slicing and dicing sort of approach, where you can make very precise sort of decision, just like what we did in the portfolio completion exercise, where if you have like a portfolio of fixed income portfolio where you need to get exposure into a different duration, then you can find an ETF that has that particular missing duration to add into your portfolio to get your exact exposure here to manage your risk, because a lot of like fixed income products or fixed income portfolios require precise cash flow matching, and that ETF can help you with that. without the risk of fund managers altering or not knowing your active fund managers' cash flows. And so if hopefully if the Asia region fund passport would be sort of expanding the ETF industry here, I hope that there will be more ETF to choose from to help you guys to risk manage your portfolio even better. So there are other ways to use ETFs. Another way is called the cash equitization. So a lot of times, say you're a fund manager and you have a fund redemption coming up. So say if your AUM is 10 billion and you have say 10% 1 billion redemption coming up, and you probably want to get the cash in advance in that case. But a lot of times, if you put it in cash and the market is going up, you're losing your sort of performance on that particular 10% because you have cash on hand, and that is obviously called cash drag. A lot of times, fund managers can use ETFs as a parking tool, and they can invest into the using that 1 billion to invest into an ETF to gain the market exposure. And because ETF is a very liquid tool, they can just sell the 1 billion portion right before the redemption is needed. So that can help you to still gain the market exposure without the risk of being trapped in cash or trapped in some low liquidity securities that is in your portfolio. So that's one way of using ETFs. And the other is called transition management. So sometimes if there's a portfolio and a portfolio manager leaves the jobs or being fired, there may be some time in between where there's no one making the decision. So the team would probably can use ETFs as a parking tool to earn market return rather than having no one to make the decision. So this is one of the transition management tool ETF can be used on. And this is also called a stopgap solution in this kind of situation here. So the other way that ETF can be used in your portfolio, liquidity management. And in a number of studies that we have performed in the US in particular, ETF is actually more liquid than the underlying basket. Equity, well, a lot of ETFs are already very liquid anyway, and as well as equity itself. But a lot of the bonds are not actually that active or liquid. And ETF is actually a very liquid tool that investor can get in and out very quickly at good prices, so that a lot of investors may actually want to pick ETFs, especially if you are a large amount of investor, having a large cash that you have to invest in an ETF rather than the underlying individual bonds, which are more illiquid. So that ETF can actually help you to get in and out quickly into that particular exposure. So, getting to the last part of my presentation, I've still got quite some time here, but well, I think I've talked a lot about how we can use ETFs and how to mix it with active funds. I would like to give a very brief sort of ways or method in which investors should actually look at analyzing ETF before investing them. So I think firstly, we should determine whether the ETF is suitable for an existing portfolio. So depending on the economic outlook and portfolio focus, and determining the role of ETF, how it would impact your portfolio before investing into a particular ETF. I think I can draw an example here is, for example, if you're investing in already a global portfolio, and you're trying to get more EM sort of exposure into your portfolio, but your global portfolio would already have a lot of EM exposure. So before investing in an EM ETF, you should be sort of doing your homework to understand your outcome exposure before investing into a particular ETF. And especially inside EM, you have very different country exposure. For example, China could be a very big sort of chunk in your EM ETF. And if your asset allocation does not want that a lot of China exposure in your complete portfolio, you should be careful when selecting the different ETFs. Potentially, you could choose an ETF that is EM but without China, or even if you have you could have chosen to invest into another EM but shorting some pure China equity ETF in order to complete your getting to your target asset allocation. So this is the suitability part that you should think about before investing in ETFs. Secondly, we actually would urge investors to look at the key macro fundamental drivers that would affect the ETF performance. Ask yourself, are those fundamentals working on your side? Are those exposure you would like to be exposed with? For example, China, for a very typical China index, is always very financially focused. So what's your view on China financials? Is the bad loan situation something that you are expecting? What's your view on that? So understand these particular factors before investing into a particular ETF. And thirdly, an index tracks an index. So investors should understand how the index is actually constructed, from what the constituents are, how these constituents are sort of exposed into different sectors. As mentioned, just like China being very focused into the financial sector. And also, for example, is investing into Brazil market index really capturing the Brazilian economy and domestic consumption, or really it is to expose to export of commodities. You have to understand the actual sort of exposure before you invest into that particular ETF. Don't just look at the name and invest into it. Be careful with that. So that's on the index construction. And fourthly, product construction. Well, after all, ETFs are different products. You should understand it before you invest into it. So this helps you to determine how closely you would earn the index return, and understanding the underlying risks. Because different product construction can get a different impact on the operating cost of an ETF. So that determines how the ETF performance would deviate from the actual index return. So you have to understand the product construction and also the risk on it. For example, how the ETF is replicating the index. Is it full replication? Is it sampling? Is it synthetic? And if it is synthetic, are there any collateral that the ETF is collecting? That would mitigate the risk. So it's more like a risk and return sort of analysis that we would like to perform before investing into that particular ETF by looking at the product construction. And finally, you will need to know how much fees are being charged by the manager who managed the ETF and the total cost of ownership. Don't just look at the expense ratio. Also look at the bid-ask spread. That is one cost that is not written in any prospectus. Is market driven because ETF is being traded on the stock exchange. So you have to look at the bid-ask prices. You have to look at the premium and discount that the ETF is trading. So these are all the all-in costs that you should be comparing against the different available investment vehicles or ETF that you have available on hand before investing into them. So, well, sounds complicated. Well, hopefully not for us, but I think for investors, one simpler way would be to look at our research, maybe, or look at other external research before investing into different ETFs. And I think as a general rule of thumb, investing into ETF is to first of all form your investment thesis. Secondly, choose the right ETF, and thirdly, to execute it. So this is the basic rule of thumbs, and looking at the 5 or 6 steps that I just mentioned, that will help you navigate through the different, the difficult, the very complex space of ETFs. So that's all the time I have. Well, I've actually got quite a bit of time, but that's pretty much all I have to say for today. If you have, do you have any other questions? Or if you have any comments on the Thai ETF sector that you have? Nope.
แชร์ไอเดียไว้หน่อยนะฮะเรื่องอะไรเรื่อง ETF Let me just break ice and throw in some ideas. Um, would it be fair to say that going forward, let's say 5 to 10 years from now, is back to basic again? As in, yeah, the greatest place on earth to invest is North America. Essentially, that's all you need. Actually, S&P 500, listed companies, the Googles, the Microsofts, the ExxonMobils. These are global companies. They happen to be domiciled in the U.S., listed in the U.S., but the revenues are actually derived globally. Half of it is actually, derived from emerging markets, and and all the EM's countries are in the doghouse right now. China, for God's sake, it's been in a bear market for God knows how long.
Yep.
Indian politics, Brazil, very disappointing. Russia, he's got Putin. And even Europe, they haven't really actually sorted themselves out, have they? So would you agree with this?
Well,
plain and simple.
Well, I wouldn't give any investment advice, but what I feel is that the world is getting more, as you said, global. Whether or not it would happen in the U.S. or not is, I don't know, is a question. But I think as the market further develops, there will be very strong businesses in the U.S., very strong businesses in China, very strong businesses in different countries. So it's a matter of how to get the actual exposures, get the actual company that you want to invest in. I think probably maybe getting S&P 500 would get you to 70% of your goal already, which because a lot of those companies are big enough to get into S&P 500. But that's probably one of the sort of goals that I would like to achieve. The other part would be to capture the additional growth or additional segments. For example, if there are changes in the political situation on Russia, it's hard to get that particular exposure when there is the chance by just investing into the S&P 500. So I think back to basics could be one of the themes to play on, but there's also situations where we have to pick at the right time on the right exposures. And also maybe there needs to be an ETF that tracks the biggest companies in each country too. That will help to get your one world exposure. Going back to my point about the market efficiency hypothesis, out of all the mutual funds universe here,
in Thailand investing in Thai equities. 50% of the managers actually do not outperform the market. Some of them have been consistently underperforming the index, and yet it hasn't gone out of business. I'm just wondering why that is actually. Is it due to the ignorance of the retail investors? And can this be that the Thai market is so inefficient from that point of view?
Whether or not it's just inefficient is hard to say, but I think this is a general phenomenon that we see in the market. Even in the US, there are like long underperforming managers that are still alive, but you can see that their asset under management will be reducing, and that one day, well, as hopefully market efficiency kicks in, that would sort of take out the less efficient one. But I think it happens quicker in the US because, well, being an ETF strategist, I think ETF has helped a lot in there because ETF being a low-cost vehicle, tracking the market. If there's a bad manager in the market, charging like 1% of my asset every year, but still underperforming an ETF that is only 10 basis points and matching the market return, I would very quickly in the second year go to my ETF, right? But I think like for maybe the Thai market, there hasn't been ways for me to like get a good enough ETF. Maybe ETF is still pretty expensive in Thailand. For example, 49 basis point. As I mentioned, like a typical S&P 500 ETF in the US charge only like a single digit, 7, 9, or 10. So that's the difference here. And so if there's a manager that in Thailand has managed to underperform the index by only 30 basis points, they will buy the fund manager rather than the ETF. So I think fees would be like the sort of cushion for the inefficiency here for now. But as the market gets bigger, that could help the efficiency to kick in as well. I think you raised a very good point here too. And investors are not stupid, and they will see it. Yeah, it's just a matter of time. So do you have any sort of advice or comments on the fund ETF industry for Thailand?
I have some questions.
Yep.
Can you share with us how ETF is marketed or promoted in some advanced country in Asia? For example, the ETF is picked by the investor themselves or being advised by the advisor. Because right here in Thailand, I think advisors do not advise investor to pick the ETF much. They advise into the product that gives them higher fees. So because I see the size is huge, so I wonder how Thailand can learn from that.
Yeah, I think, well, I'll ask the question back to you. Why have advisors not advising on ETFs then? Because of the charges that, well, commissions that they get, right? So I think one, well, I wouldn't say Asia, but if you look at like the US and Europe, one driving force in advisors promoting ETF is because of the low cost, and also because they have moved many years ago, moved from the commission-based advisory to fee-based advisory. So before, when it is commission-based advisory, they would very much ask you to go into the very expensive mutual funds so that they can get the commissions or everything. But after they switch into the fee-based advisory mode, they will go for the cheap vehicles that will achieve investors' goals, so that ETF is a very good tool to actually use in their advisory. But so far in Asia, we haven't seen this particular move going on. from commission-based to fee-based. And Singapore is one of the country that have had some consultation in moving from commission-based to fee-based. But the actual market participant feedback is very negative. They say, oh, we're not ready. But obviously, this is a conflict of interest, right? They obviously don't want to have less money, right? So I think it's just very much a, a regulatory move to move from fee-based, from commission-based to fee-based. And also as globalization kicks in, if there's a client, say in Europe or US, is using HSBC for fee-based advisory, when they come to Hong Kong or Thailand, why am I not getting like a fee-based? Why am I charged commission? So one day, well, as time goes on, this hopefully will kick in globally, and that's when at the time would probably have advisors to be more willing to use ETFs, being a low cost. But obviously, I think I would draw back to this picture to, well, ETF is still expensive. I think one reason is also on the size itself, because some of the cost on ETF is fixed cost. If the AUM of the ETF gets bigger, they can do cheaper ETFs. But I think, well, as time goes on, the market gets bigger, fees can, more competition, fees can come down.
Okay. About when you look at the number of ETF in like Hong Kong, Korea or Japan, I want to know how many indexes in that particular country. That is something relative to between number of index and number of ETF.
Relative to, well, I think the more index there are, there could be more ETFs. But the thing is, I think it's more correlated to the size of market, I would say, rather than the actual number index, because sometimes it's the products offerings that are driving the number index. If there's demand for some kind of product, there would be some kind of index that comes out. It's like a sort of negative feedback here, rather than like index being the chicken and then ETF being the egg. Well, it might not be the case. It could be the other way around too. So I think it's more like the size of the market. For example, if the market is small, there cannot be that many variety available, especially like if there's a sector tilt perspective. Well, say a dividend tilt sort of index that they want to sort of set up. There might not be enough constituents to make an index even for a small market. So the size of market could make quite a lot of difference, especially for the fixed income space as well. And that's probably one of the reasons why we haven't seen a lot of China onshore indices and or dim sum bond indices, only one or two recently launched. It's only when the market is long enough, like more than 5 years sort of history, then you with enough sort of constituents, that's the time when you can actually start having an index. So, and that's one reason why US have a lot more indices and also ETFs, because the history is a lot longer for every asset classes. But that's some sort of like I would say, well, we are a bit behind for Asia, but we're catching up fast.
So can I imply that about strategic beta ETF, that is a long time for Thailand?
For Thailand, on the exchange, there's one, which is based on high dividend ETF. So only one that is available for now. But I think if you look at like the definitions that we have here, a lot of like equal weighted is very easily composed with any index. Why not?
Do we need equally weighted index before the ETF can emerge?
Sorry?
Do we need to have an equally weighted indexes before we can launch first ETF, or we can create ETF
Right. Well,
without index?
it has to have an index first, but sometimes it's more like the ETF providers seeing there's a demand. They will ask the index providers to create that particular index.
Oh, you mean that some guy need to create an index first?
That's right. Yeah. Say for example MSCI or FTSE, they're willing to provide. Well, they're willing to create different indices on request.
Can you share your experience in Hong Kong about the proportion of investors who use ETFs? Most of them are retail investors or professional investors?
Well, by definition and by size, it has to be institutional investors that are investing in ETFs. But one of the survey that the Hong Kong Exchange have performed, 20% of the retail investors have been using ETFs. So that's one of the survey that they sort of publish every 1 or 2 years. Yep. Yeah. But definitely in every market, even the US, by definition or by size, institutional investor has to be the bigger ones. Yeah, I think that's a little bit different in the Thai market. Yeah, I think one of the reasons is on the on the cost, and also on the adoption or the familiarity of the product, as well as whether or not the fund managers can actually replicate the index themselves easily enough, rather than using the ETF itself. Yeah. Yep.
That table that you compare ETF Thailand with other countries in Asia, just wonder, have you looked at this kind of table but with mutual funds instead? Because ETF is not the only alternative to stock. You can buy mutual funds too. So I just wonder if maybe it's not about market maker, not about regulators, so it's about the preference of investor. Like you can buy ETF or you can buy mutual funds, and it happens that in Thailand we like mutual funds more.
Well, I haven't got that particular picture here, but yeah, as you said, having like the mutual funds comparison here would be like interesting too, especially that we can use different strategies with ETFs and active funds. Right, probably, yep.
I would like to asking about trading strategy by using ETF, because nowadays I heard many people talking about trading strategy by using ETF, because maybe they believe that the value won't be able to be zero. Do you have any view to talking about this strategy? Like grid zone or KZM, something like that.
Sorry, I didn't quite get the last part. The trading strategy of ETFs?
Yes, by using ETF.
Sorry, I didn't quite get your question, but I think there are, what I explained was the ways that we can use active managers with ETFs, but there are a lot of different ways in which we can use ETFs on a trading purpose or other purposes. For example, there are long short strategies as well. For example, if there's taking the Thai market, for example, if even this particular here, if you're holding a TAIDEX ETF here, which is the hallmark, the top 50 ETFs in the market, and if, say for example, if you see that the energy sector is not going to perform well, you can short an ETF too on the energy sector. So there's a long short strategy there, which the short portion can provide you with the funding to your long side. So there are a lot of different strategies in terms of trading ETFs. Yep.
as you mentioned in the last answers, like when we would like to shift our exposures from sector to sector, but we still don't want to physically commit the fund to that allocation yet. That you say we can use ETF. So I wonder, like, can you compare the usage of ETF and the derivative? Because we can also use derivative instead to like allocate the fund to other sectors.
That's right. Sorry, I don't have that particular comparison, but this would be a very interesting research to
Yes,
done.
because the major concern is that when I use ETF, right, I need to put the money into it. But if I use the derivative, I need to put only the margin.
Mm-hmm. Yes, but if you use derivatives, there are other risks, obviously, in your sort of execution. For example, if you're on the margin basis, you are still exposed to the actual risk. So I think your compliance department would be looking at it on a sort of what you call the absolute level rather than the just margin level. Is using derivatives is like a leverage way to invest, but buying an ETF is like you're putting the money in there. Using derivatives is like a little bit like leverage as well as, well, I wouldn't say gambling, but yeah, there are other risks in there.
I don't mean that the way of using derivative to leveraging.
Right.
I mean, like I put the margin so that I can open the position in the derivative, let's say a future contract, and I use the less of money to invest in a risk-free bond or treasury bill, and I get the risk-free rate from that.
Mm-hmm. Yeah. Well, I haven't done that particular exercise, but that would be an interesting sort of study to do. Yep. But it's well, I want to know the answer too. Yeah. Right. So that's probably the time that we have for today. One more question.
Can we get back to the table about AUM of each country? Can you share us more detail on the competition in like Hong Kong or Japan, top 3 or top 5 ETF fund, are they invest in the same underlying or different underlying index?
Mm-hmm. If you're comparing between like Japan and Hong Kong, it's very different.
You can give just one example if you know for sure.
Yeah. If you look at like Japan and Hong Kong, they are very two different markets. Japan is, although a very open market, is sort of very close, where they have like local investors investing in local products, local exchange as well. So this is sort of their investment mentality too. And the top 5 are definitely the ones that are investing back into the Japanese market. Whereby for the Hong Kong market, it's slightly different. The top 5, 3 out of the 5 have exposure into the China, and 2 of them are invested in the Hong Kong market. So in Hong Kong market, by definition, by statistics, over 50% is actually in China. So after all, China is what's influencing Hong Kong, and that's something that Hong Kong has the advantage to, in which Hong Kong is the gateway to enter into China in the investment as an investment channel. Yeah, so this is sort of like the advantage that Hong Kong has got, and this is an important sort of opportunity for Hong Kong too, because in all these countries, only Hong Kong has a very good sort of financial arrangement as well as policies which the China government has given to Hong Kong to invest directly into China. Neither did Australia, Japan, Korea has. So Hong Kong has that particular exposure without competition, I would say. Yeah.
what I wonder is that this is normal that the winner can, I mean, different funds can invest in the same underlying and still coexist as a winners, or just one top fund that will be the best fund for that underlying index.
Usually what we see is that for a particular index, AUM of the top ETF would already account for like 60-70%. The second one gets 10-20%, and the top three are already getting like 80-90%. That's usually the sort of mix in terms of AUM, and because, well, if you think about it as an investor, if there are 5 ETFs that I look at that are available with the same index, it's always the cheaper ones that will probably get my attention, or the ones that has good liquidity, which gives me good execution on a lower total cost basis. So there are only like 2 or 3 ETFs that can give me that particular sort of comparative advantage, obviously. So as time goes on, investors will choose the better ones to get in, so they will gather into the bigger ones and better ones. The biggest gets bigger. So usually that's always the case. And usually it's the local exposure that is has the bigger AUMs in the different countries. Japan, you have the local local TAIEX or the Japanese index being the biggest ETF. China as well, the CSI 300 gets most of the AUM. Hong Kong, Korea has the KOSPI. Singapore has the Straits Time Index, STI. Thailand, the TAIEX as well. So it's always the local index that gets the biggest, local index ETF that gets the biggest AUM. Which makes sense because usually the foreign, the local investors are more familiar with the local market, and they would be more willing to invest into that exposure.
Anybody else? Let us share ideas on how to make money the easy way. No, let me just share this as a parting shot, actually. You mentioned about combining, passive and active. Okay, so basically for passive, I use, ETFs, S&P 500, plain and nice and simple. For active, I use Warren Buffett, which is quite interesting, actually, that I don't have to pay him a dime, So I'm a shareholder of Berkshire Hathaway. And, Berkshire Hathaway will be celebrating its 50th, birthday next year. Warren Buffett's been raking up 19% per annum over the past 49 years. Book value of Berkshire Hathaway, $19, and it's now $138,000. Very nice and simple, long-term. I don't know what to call Warren Buffett, actually, whether it's value investing or passive, but it's mostly buy and hold.
Buy and hold.
Yeah, so I just use these 2 combinations. S&P 500, 10% per annum for the past 50 years. That's good enough for me already. And if you have Berkshire Hathaway clocking up another 19% per annum. Okay, even the Thai market, actually, for the Thai portions of my portfolio, my clients use TMB Z50, nice and cheap, as core holdings. Some of the active managers, you mentioned, Aberdeen small cap. I like that. Expensive, but I like the performance. Aberdeen Growth. I also like Krungsri dividend, equity, but I'm not willing to pay the fees. 2.2. No, seriously, 2.2% per annum. Fantastic fund, fantastic performance, but I just can't bring myself to pay that kind of fees. And the other funds that I like is the Bulong series. Actually, if you go back and look at Bulong Tosapon, over the past 10 years, they've got 10 stocks. And what's really amazing is 10% in BBL, 10% in BLA, 10% in CPO, and portfolio turnover 30%. So I take my hat off to these guys. Actually, they're very sure-footed. They do the homework, pick just 10 stocks, and sit tight. And over the past 10 years, they outperformed the index by miles. Actually, Aberdeen growth, 900% growth versus 300% for the said index. Amazing.
I hope we can have more sensible investors.
Yeah, I know. So,
and actually, you are very focused into Warren Buffett family, because Warren Buffett actually also advised his wife to invest into S&P index.
Exactly.
Well.
So he did say that when he dies, he's going to put the bulk of his inheritance into just S&P 500
Yeah, I think it makes sense
index.
because everything is over on a total cost basis. So it makes sense for you to not invest into a fund that is charged very expensive, although have a good performance. If they can beat the benchmark above their fees, then it's a good investment. But there takes a lot of work in terms of choosing the right managers to do so. But I think one phenomenon that we see in the Asian market especially is that a lot of investors like to make their own investment decisions. Whether or not to choose their own stocks or choose their own fund managers, and whether or not they have done the homework is the other question, which is the key question too. Or they may be just choosing it by someone talking about it. So I think investor education is very important here. And also the other perspective that is also important is that you talk about long term being 10 years, but in many other Asia investors, 2 years is already long term, right? So it's a very difficult environment that we are facing here. But looking into long term is something that we, as a firm, Morningstar, is very dedicated and looking into. We always advise investors to look long term. It's the long term that gets you the win, not the short term bips or bumps. So do your homework and make sure. And potentially Warren Buffett would potentially continue to outperform, but as always, past performance does not represent future performance. So, so we have to be aware as well. Yeah. Thank you.
On behalf of the Stock Exchange of Thailand and the partners, today we would like to thank Jackie Choi, not Jackie Chan, right? Okay, for your time and your experience. It is valuable for all of us. Thank you.